Hello, and a good day to all. This is Larry Tentarelli with a public blog and video for Blue Chip Daily Trend Report. Today is March 15th, 2020, and the title of today's video is going to be hopefully a 15-minute or less video, and there's a blog that goes with it. But the title is Professional Trading Concepts Using Stops and Position Sizing to Manage Risk and Avoid Major Drawdowns. So before we get started, just to briefly touch base on the disclaimer, it says that everything in this video and on my website is for general informational purposes only, not a recommendation to buy or sell any securities, and it's not to be considered as investment advice. Then we're going to take a look at two charts through the blog. One is going to be a chart of Apple, and then one is going to be a chart of GDX, which is the gold miners ETF. They are both sample charts only. So we'll get started with the video, professional trading concepts. So a couple things. In the blog and video, I'm going to discuss two core risk management strategies that I've used over the years, and especially recently, to help me reduce drawdowns and minimize losses. So as we know, the S&P 500 just went through a 26% drawdown in 16 trading sessions, 3393 down to 2478, closed for the week just over 2700. So this is not a market analysis blog. So I'm not going to speak about the S&P 500 or anything like that. What I am going to talk about is managing the risk and the drawdowns. So what I've read online over the weekend is there's been a lot of private traders and even some bigger hedge funds that are in the news right now that they have not been positioned correctly, and they've seen some very steep recent losses. Now, what I will say is there's much more to professional trading and investing than just making daily random market calls, maybe drawing some trend lines or arrows on a chart and hope that it goes right. As we've seen, markets go where they go. They can go right through moving averages. They can go right through trend lines. They can go right through oversold signals. They can be very volatile. And what traders do when they get it wrong is what keeps them in the business over decades. Now, I've been trading since 1998. My time frame is geared towards intermediate to longer term position trading and investing. Investors, but the basic concepts apply across all time frames. Now, just to spend a minute, I focus on reactive price analysis. So what that means is I don't make predictions. I just trade what's actually happening on the screen. I focus on trend identification and exact risk management and position sizing. Now, we've been fortunate. We've been positioned very defensively, and we've avoided the vast majority of this drawdown, as I've been building cash since 225 as outlined on our premium feed. So on the 19th, I raised stops. On the 25th, when the S&P broke 3,200, I went to full defense, which means just let the stops get hit, build cash, don't chase anything on the way down. By February 27th, I had my equity weighting down to 30%. By March 6th, which was going into last week, which was a very big down week, I had equity weighting down to 18%. So I used exactly what I'm going to talk about to raise my stops, move defensively, and then go to a high cash exposure before this drawdown really took place. So I'm going to talk about two major risk management strategies that I incorporate every single day. And what they are: number one, stop losses. So what I do when I take a position is I know exactly what's going to get me out before I take the position. I use good till canceled hard stops in the system, which I'll talk about in just a minute. Number two, I use position sizing. So I know exactly how much I'm prepared to lose on any trade if it goes against me. And then I look at the big portfolio level risk sizing, which is I know if every single position goes against me, how much it's going to cost me as far as versus my equity. And this is how I manage the risk. So the first thing we'll talk about is stop losses. So the way that I learned risk management is I want to know exactly where am I going to get out on the downside before I get in so I can manage my risk. What I do is I assume that every single position that I take is going to go against me and get stopped out. So when I get a trade entry signal, the first thing I do, I identify the downside stop. I base my position size on that. So my stops are volatility based into a fixed percentage. So for this blog, to keep the math simple, I'm going to use a very basic 10% stop, but my stop ranges can be wider or more narrow based on the trade signal, time frame, volatility. But I use GTC hard stops in the system. What that means is when I get filled on a position, I put my stop in right away. So we'll take a look at the example. So this chart, this is an Apple chart, and we can make this a little bit bigger. But what I'll do is I'll just go to the big chart. So in this example, we'll assume, and this is just a hypothetical example, not a position that I'm in. So we'll assume, for ease of math, a 305 entry in Apple, which a trader could have used a bounce off the 20-day moving average or any various signal, but a 305 entry, we'll assume a very basic 10% stop. So a $30.50 stop. So the hard stop loss would go into the system at 274.50. So in this example, as soon as the trade gets filled at 305, the trader would go into the system, put in a good till cancel hard stop just under 274.50. So we'll call it 274.49. And as soon as that breaks, the position gets closed out by the system. So what this does is it puts a mathematical process into it. It puts a rules-based process into it, so the trader isn't going to sit there every day and try to look at the chart and try to figure out what's going on. We get the entry signal, we size the risk, the stop goes into the system, and that's it. So a couple things. I don't use closing price stops. So what that means is that if I take a position at $100 and my risk is defined at $90, as soon as it hits under 90, as soon as it breaks below 90, then the stop gets filled and I'm out. If I define my risk at 90, why would I wait until the close when the stock could be much lower? So if I take a position at 100, and obviously the reason that we all take positions is the anticipation is we would like them to go up. But for some reason, when they don't, if I take a position at 100 and the stop and it starts to go down and it hits 90, then I'm going to get out of the position. I'm not going to wait until the close, because what if I take it at 100, the stop is at 90, it opens at 91, and then it goes from the data 90, 88, 86, 84, 82, then it closes at 80, and now I get out at 80 when I said my risk was at 90. So by using a good till cancel hard stop in the system, if it hits 90, the position gets closed out. I don't use mental stops. So Paul Tudor Jones spoke about this in the Market Wizards book in 1989. And at the time, he was the largest trader in the S&P futures pit, and the traders on the other side of the trade knew where his positions were and where his stops were. Well, the reality is none of us is Paul Tudor Jones. These are very, very liquid markets with much tighter spreads than 1989. It's all electronic. And what happens to me is in this market, a mental stop is just another way to say that we don't really have a stop. So Apple traded 92 million shares the other day. So whatever your position size is, whether it's 1 share, 10 shares, 100 shares, 1,000 shares, in a 92 million share market, our position size is not something that they're going to bring the system all the way down and run the stop. So at the end of the day, if I take a position and I've got a 10% stop, the stop goes in the system. If it gets hit, it gets hit. I'm not going to use a mental stop, and I'm not going to micromanage the position every single day. Now, there's an exception, and there's always rules and there's always exceptions, and exceptions come from experience and from skill. So in the rare instance of a general market gap down, which we have had recently, through the stops, I may remove the stop briefly in a core name. So let's say I've got 5 or 6 open positions, and it looks like the market is going to gap down through all the stops. I may identify my core name, let's say it's Microsoft or Apple, and pull the stop out on that position just for the opening gap. I'll let all the other positions get gapped through and stopped out right away. But then as soon as the opening gap is done, then the stop goes back into the system. So what I want to avoid, and this is what experienced traders will do, is to avoid getting flushed out of all the positions on a gap down and reversal. But this is something that comes from years of experience and having the discipline to put the stop right back in, and if it gets taken out, it gets taken out. This may happen a few times a year at best. In a low volatility market, it doesn't happen at all. In a higher volatility market, it could happen a little bit more often, but this is obviously the exception to the rule. And for someone that's just learning how to, when I was just learning how to use that, I just would stay with the hard stop, which is what I want to stay with 99% of the time. So in summary, I define my risk and my stop levels at entry. I use hard stops, good till canceled in the system, not closing stops or mental stops. So the second thing we'll talk about is position sizing. And position sizing is probably the most important aspect of trading that professional traders and investors focus on constantly, and that novice traders either have very little knowledge about, and those who do often don't use it. And this is position sizing. So the concept is when a trader says that they are risking 1%, it does not mean that they are putting 1% of their assets into a position. It means if they get stopped out, the loss will be 1% of equity. So we'll use a very general example, round numbers for easy math. General example, $100,000 account. Somebody takes a position with Apple. They determine it's got a 10% stop. So their position size would be $10,000. And what this means, if I take up a $10,000 position, if I run a 10% stop loss, if I get stopped out, it costs $1,000, which is 10,000 times 10%. So my loss is 1,000. My account equity was 100,000. It's a 1% loss. So when they say they're risking 1%, it doesn't mean they're putting $1,000 into Apple. It means they're putting 10,000 in with a 10% stop. If they get stopped out, it's 1% versus equity. So this above math is a very general example. And I will say that what I explained here in about 30 seconds probably took me 3 or 4 weeks of really studying it when I was starting to learn this to really understand it. But it's a very general example. And to back into the math, a trader first determines their overall account risk position sizing, stop loss range. There's a lot of variables to it, which leads to a much more detailed discussion on sizing, position management, risk management. So this is something that I focus on every day. I can generally do the math in my head in a few seconds. And I've done an educational video and blog for my website members on February 25th. So this is just a screenshot. And it was a much more, it was maybe, I don't know, a 15-minute or so instructional video. But basically what I did is broke down the variables using volatility, position sizing. And this is professional risk management. So professional trading is not firing up the computer and looking at a chart and just making a random call with what we think the market's going to do today or tomorrow or what a stock is going to do. It's more about risk management, position sizing, stops, and what do we do when the positions go against us. So this was, as I said, this was just an example. We'll take a look at a chart. So in this example, GDX, I do not have a position here. This is not a great chart, a great outcome, but we're going to take a look just at the math. So we're going to talk about position sizing. In this example, we'll use a random $28.50 entry signal in GDX. We'll assume the 10% stop, 285. So the stop would be just a break below 25.65, 10% stop. And so the trader is going to put 10% of their money into this position with a 10% stop, and that means they risk 1% of their money. So if it doesn't work out, they lose $1,000 versus their $100,000 account. So we'll take a look at this. Entry at 28.50. The stop is just under 25.65, so we'll call it 25.64. And then what happens is as soon as the price goes through that stop, then it gets stopped out, closed in the system. Now we can take a look. So GDX, if we take a look at this in 1, 2, 3, 4, 5, in about 6 days, it went from, we'll call it 30 to 16.50. So that's probably about a 45% or so drawdown. Just because this went down 45%, if the trader does their stop loss placement correctly and their position management correctly, then the entry goes here, the stop goes here, the risk gets sized at 1%. And even though this had a 45% drawdown, the trader gets the position closed out with a 1% hit versus equity. So in that above example, I did not have a position in it. And what happens is we can see on Friday, GDX went down 14%. Well, even if the trader had whatever their entry and exit was, if they had a 10% stop and 1% of risk, then they would have seen a 1% drawdown versus equity as opposed to 14% in the position. So the size, the drawdown in the position isn't what affects the account volatility. It's how much they have at risk. So in this case, if the trader capped their risk at 1%, they'd have a 1% risk. The position would get closed out and they move on, a very mild versus the overall drawdown. So the bottom line here is that to trade or invest professionally and make it through decades of various market conditions, traders and investors must focus on professional risk management, money management strategies as the core component of their plan, which goes significantly beyond the context of just making a daily random market call, trying to figure out what the next 5 ticks are going to be in the S&P, or putting a few trend lines and arrows on the chart and hoping to get it right. Because what happens is positions can go against us, markets can go against us, it can happen very fast. And those who learn and master the math of risk management, position management, and money management are the ones that make it through relatively unscathed with very, very minor drawdowns and have themselves in a position that when the market starts to move back in their direction, whichever that is, then they can capitalize on it. So I appreciate everyone's time for listening to the video and going through the blog. I will get this posted shortly.